What is going on, investors? Welcome to my channel. This is Jason, aka the Frugal Investor. The markets are down today. S&P 500 is down by almost 5% of its recent highs. If you look at my portfolio is down by almost 4% just within this week. Within the past month, it is down by almost 3%. It is a really bad day for the markets today. In this video, we will talk about why this is happening, what's the reason for this sell-off, and what you can do as long-term investors in situations like this. With that said, please don't forget to like and subscribe to the channel. Let's get right into it. If you watch my video on Evergrande disaster last week, I predicted this in that video that we will have a red week, month, or even a year because of this situation. The main reason this sell-off is going on today is because of Evergrande in China, which is the second largest real estate development company in China alone. It employs more than 4 million people, directly or indirectly, and its balance sheet is ridden with debt. That company is so much in debt that its debt is equal to 2% of China's GDP. The company is on the verge of failure, and if it fails, it can crash the markets not only in China but everywhere else. That is one of the main fears this sell-off is going on. Now, the second reason this sell-off is going on because of the Fed taper meeting that is coming on this Tuesday. So they are trying to taper, they're trying to reduce the amount of securities that the Fed is going to be buying from now on, reduce the amount of cash that they're dumping in the economy. That is also the second reason this sell-off is going on. The third fear that's in the market right now is also the debt ceiling. So we are at the deadline for our debt ceiling. They are going to increase it sooner, but they haven't talked about it yet. They're fighting with each other. They haven't come on a decision yet. So the debt ceiling issue is also a fear in the market. So these are some of the main reasons this sell-off is going on. A lot of retail investors and a lot of institutions are taking their money, taking their profits, and they're running away from the markets. If Evergrande fails and there is a crisis in China, it will affect the whole global economy. If the Fed tapers, that will affect the markets in some way. If the debt ceiling is not raised and the deadline is approaching, if they fail to do that, then we are in the danger of defaulting our debts. So that is also like very big fear. I think they will default. I think they will increase the deadline or kick the can down the road, but that is also the fear that's plaguing the market. So these are some of the reasons that the sell-off is going on right now. There is fear on the street because people are anticipating even a bigger dip in the securities market. Morgan Stanley is predicting a 20% decline in the S&P 500 just in this year alone. A 20% decline, not a 5%, not a 4%, a 20% decline in the S&P 500. So the market is crashing and we might be on the start of a very long bear market. So what do long-term investors like you and me do in this situation? Should we be selling? Should we be playing with options, or should we buy the dip? The correct answer is buy the dip. There is fear in the streets, and most of these fears are short lived. They will not be here 5 years from now. The best way to take advantage of this opportunity is to buy the dip in great businesses that are available at a decent P by E ratio, that have great leadership, low debt on hand. It is the best time to build up your positions in those businesses. And the strategy I follow to build up my positions in those great businesses during these unsure times is I buy them slow by slow. I don't go all in. So I hold my cash, but I buy them slow by slow, one day at a time, 1 month at a time. I spread my cash out to at least 12 months. During those 12 months, I'll buy little by little by little, dollar cost average. If the bear market goes on for longer than a year, I will keep buying. If it goes for less than a year, I will keep buying. As long as I dollar cost average during these times and take advantage of these opportunities, that is the best strategy that's been working out for me, and that is the strategy that I follow. So when red hits the market, I take it as a start of a bear market. Even if it's not a bear market, I take it like that and I start dollar cost averaging, slowly buying the dip when it goes down and then buying the rise when it comes up as well. I have been preparing for this dip since last week. And those who have been watching my channel, you guys know that I've been talking about this upcoming bear market or the market crash for the past month itself. I also try to be as transparent as I can with what I'm buying, what I'm selling, and where I'm putting my money. And I put my money where my mouth is. On this channel, I try to keep it as honest as I possibly can. In this dip today, I have been holding up cash. I have been holding at least 10 to 15% of my portfolio in cash, and that is what I have been telling everybody on this channel. Today, I'm going to deploy some of that cash to buy this dip, the red day. Today, as of September 20, I'm buying some 3M, I'm buying some Home Depot, I'm buying some Google, some JP Morgan, a little bit of Facebook, JEPI, Apple, PepsiCo, Comcast, and Realty Income Corp. These are the businesses that I'm buying today, and I'm taking advantage of that dip. As they say, never squander a red day. This is what I'm doing in my portfolio. The market now, after 3 p.m. it's coming up a little bit. Currently it's 4 o'clock. It's coming up a little bit now. It has recovered, but not still in the red for this week by almost 3%. So as it if it goes down more, I'll be buying more, but I don't think it'll go down that far because the valuations are still strong. The country is still growing. People are still going out and spending money. The COVID fears are dying down. There are these short-term fears, but in the long term, it will all be nulled out. If you are a long-term investor, the best opportunity, the best decision, the best advantage you can take of these type of opportunities is to buy when the market is in the red, and that will allow you a position to build up your positions in the great businesses at great prices. The biggest losers in my portfolio today are technology sector, which is the most in red, followed by the financials and the consumer sector. Technology sector is down by almost 3.21%, and Comcast is also down by 6% almost. Followed by financials, which is the banking sector, is down by almost 4%, and industries, which is also down by 3.5%. So all these companies, whichever one is down, I bought my favorite ones. My favorite company is 3M. I want 3M to go below one. It's currently trading at 179. I want it to go below 179. If it goes below 179, I'll be buying this company because I want the price to go somewhere around 140 to 150 because I want to reduce my average share price entry point. My entry point is $191, but for this business, the right point is somewhere around 140 to $150. And if that happens, I will be buying more. It's a very stable dividend paying company. As they say, you're never far away from a 3M product. Their products are everywhere. My biggest purchases for today are Google, Apple, and Facebook. Now, Google is also down today by almost 3%. Apple is down by 4.5%. Apple has been down this past week. It's launching its iPhone 13, and there are fears surrounding that. After iPhone 13, what will it launch? The future looks uncertain, but that is a good time. Apple is a stable business. They have so much cash on hand. They can always innovate. They are always innovating and coming out with new things. So Apple, I'm holding for the long term, and today was a great day to buy, so I've bought some more. Facebook is still available at a cheap price, down by almost 6%, and that is a great news. If it goes down, I hope it goes down more, and I will be buying it. I'll be buying Facebook more and more and more. It's one of my favorite businesses. Now, that is what I'm buying today. I didn't buy any more Alibaba because I'm not going to buy anything in China now, as until they figure out what's going on with their situation, what they're going to do about Evergrande disaster, what policies are they going to come up with to tackle these situations. Based on that, I will be making my decision, but I'm not buying anything else in China. I also bought some JP Morgan and Chase, which is also like a savings account. It's one of my favorite companies to buy. It's down by almost 4% just this week. So that also gives me a great opportunity to build positions in this business. This is almost like you're investing in a savings account that gives you a dividend every year. And that dividend increases year over year over year. So there is nothing better than that. This is one of the most safest institutions. Also, they have like almost $1 trillion in cash that they can always deploy if things go south. I also bought some JEPI, which is down by almost 2% just this past week. And within the past month, I think it's down by almost 3%. So I also bought some JEPI, stable dividend paying ETF from JP Morgan. In the past month, healthcare has been the biggest loser. It is down by almost 10%, and AbbVie and Johnson & Johnson are my only two holdings in this sector. I did not buy any more today, but I will be buying more maybe tomorrow or day after tomorrow if they keep going down. Right now, AbbVie is down by almost 10%. So if something happens, I'll be buying tomorrow. If it goes more down, they are stable dividend paying companies. So that is my 2 cents on why the market sell-off is going on today, what you can do in your portfolio as a long-term investor to take advantage of these red days, how you can dollar cost average slow by slow when the market goes down. Don't jump all in at once. Make sure you buy it slowly, just like I'm doing in my portfolio. I try to buy it slow, and as it keeps going down, I buy more, and if it starts coming up, I keep buying. So as long as I'm dollar cost averaging, it gives me a really great average entry point, and I come out as winner in the long term. And I only buy great businesses with low P by E ratios that have great CEOs and great management, and that's how I follow my strategy during the red days. I will also leave a link for my M1 Finance Buy down in the description below. Please don't forget to check it out so that you can know which companies I hold in my portfolio, 22 companies that I hold, and which companies I have recently bought and which companies I recently added. Let me know in the comments down below which companies do you hold and which companies do you like the most and which companies you are buying in this dip. Please don't forget to like and subscribe. This is the Frugal Investor signing out.